We help them figure out, okay, what's the business worth today? And then where's kind of the blue sky, or where's the most efficient places to invest in your business to maximize the return? Oftentimes, there's enough money wasted within the business to reinvest in the business to grow the business, which sounds crazy, but we'll kind of go over it. Good morning. Ralph here, Zatara Transaction Advisors based out of Saskatoon. I just wanted to talk about one of my favorite parts of our valuation, our premium valuation here, is basically the risk analysis and the value enhancement and the efficiency analysis, and then the value gap analysis. So we all got into business for the same reasons, right? We want the freedom and we want to make money, right? Those are the reasons you get into business. The only reasons that you'd want this crazy life of being an entrepreneur are to make money and hopefully get some freedom, right? And so I wanted to go through. This is kind of what we do for helping people grow their company. So first, we help them figure out, okay, what's the business worth today? And then where's kind of the blue sky, or where's the most efficient places to invest in your business to maximize the return, i.e., maximize the value of your business, right? So that means reducing stress and hopefully making a bunch of money, right? So our value enhancement stuff, oftentimes there's enough money wasted within the business to reinvest in the business to grow the business, which sounds crazy, but we'll kind of go over it and we'll talk about it. Okay. Okay, so the first thing we normally deal with is the marketability risk. So the listing price, obviously, depending on how big your business is and how much net profit, how much EBITDA, that's going to determine basically what the price is going to be. Also, the risk in the industry, that sort of thing. So you got your revenue, net profit, EBITDA, industry. Can't really change those. Geography, single points of failure. You can change this, and we'll talk about that here. So, regulatory environment, can't really change that other than maybe slightly changing your business model so you don't fit in those regulatory boxes, or making sure that you're more than 100% compliant, right? Customer concentration, there you go, that's one. So obviously, the more concentrated your revenue is on one customer, right? The riskier it is, the less you can't sleep at night. You can think of risk as stress, right? So de-stressing your business, that's a better way to put it. Instead of de-risking, de-stressing, making you less stressed out. So obviously, you got to diversify your customer base. The more diverse your customer base, the more diverse your revenue, and the less probability of, if you lose one customer, if it matters, right? The less the customer controls you. Rather than you controlling your business, the customer's controlling the business. Same with supplier. If you only have one supplier, we found that out during COVID, right? You weren't able to get product in, or you may not have been able to get product in because one supplier had supply chain issues and it messed up your whole business. So there's a couple ways to do that. You can vertically integrate your business, right? So you can become your own supplier. That's number one. So buying your supplier. Number two is you just have more than one supplier, right? Even if you buy your supplier, you're still going to have supplier dependencies, unless you have a whole bunch of suppliers that can supply to you what product you need, right? Operations, obviously, the more dependent the business is on you, the less you can work on the business and the more stressful your life's going to be. So helping you move out of your business so you can work on your business, or investing in making yourself redundant, right, is a good way to generate value for yourself. Good way to de-stress your life. Key person dependency, obviously, if you have one person in your business, who is irreplaceable, well, that person kind of controls you and your business. So you don't want the key person dependency. Lease terms, obviously, you want to have a long-term lease in place. You want to have it longer, 5 years, 10 years, whatever. The longer out it is, the less fluctuations there are in this is a key. These are all like key person, lease, facility, suppliers, customers. These are all, well, customers isn't, but suppliers and key person, lease. They're all suppliers basically, right? Your staff are kind of suppliers. They're an input, and so diversifying these inputs and then locking in these inputs is going to de-stress you over the long haul, right? Facility, mission, vision, and values and culture. Obviously, having everyone aligned, everybody pulling in the same direction reduces stress for you. Facility, obviously, the more well set up your facility is, the less, if you have big capital projects that need to happen, taking care of those is going to de-stress you, de-risk you in the long run, right? Financial controls and reporting, legal and contracts. Obviously, the more stuff you have on a contract basis, the more stability in your business. So the more recurring revenue, right? That's what these contracts provide you, is recurring revenue. The better off you are. They also fix your costs, so your costs aren't going to be all over the place, right? Like with this lease, or with a supplier, or with your staff, right? So getting that all kind of taken care of. And then growth, obviously you want upward trends. So making sure your sales processes and marketing processes are well kind of hammered out, and making sure that you have a system that you can basically put money into marketing and it'll translate into profit for you at the end of the day, So having a clear value proposition. Obviously, you're not going to know whether or not you're making money unless you have clear financial reporting. So making sure you have that. Overall scalability, obviously, you're looking for underserved market pockets where you can serve them better than anyone else, right? That's how you generate clients, customers, right? Management and staff, again, making sure that you have standard operating procedures, systems and processes, that sort of thing. HR, having all your HR documents kind of lined up, so that hiring and stuff. This all allows you to scale. So if you've got a grade that's lower than 50, these things are going to add stress and make it more difficult for you to grow your business, right? Barrier to entry, obviously, the higher the barrier to entry, the harder it is for somebody to steal your lunch, the more stable your cash flows are going to be, and the less stress you're going to have, right? So risk and stress, kind of, I equate them to the same thing. They probably aren't. Risk is the total amount you can lose, I believe, is risk, and the percent chance of that happening. But it's stress. Customer satisfaction, location, capital structure, and uses. This is what I was talking about. So you might have a bunch of money within your business that you didn't even know about, that you may be able to just redeploy within your business to either invest or to pull out, right? You can pull the money out if you don't need it. Obviously, going through this whole program, your goal is to grow your business, right? So tightening all these capital structure issues up is going to free up capital for you to then redeploy in your business or, reduce your debt, right? Anyways, so your CapEx requirements, capital structure, inventory, sales cycle. Obviously, the faster you can turn stuff, the less inventory and capital you need to run the business. Cash reserves, and then this is more deal term stuff. It's not really that important for value enhancement. It is, but I mean, you can create a lot of value here. This is really important if you plan on selling in the next couple of years. Same with the saleability stuff, right? Making sure you have a really saleable asset, and then obviously making sure that that you structure the deal in a way that it's easy for someone to get in, right? This is going to add value. Oh, the efficiency stuff though is kind of, I find this the most interesting because within your business, right, the debt, equity, total capital that's required to run the business, you may be using more capital than you need, right? So we'll talk about some other stuff first. Break-even analysis. Obviously, after a certain point, you now are keeping 23 cents of every dollar of revenue that goes through the system, right? That's the profit. Sort of cover your fixed costs. Again, if you lower your fixed costs, then and variable costs remain constant, this break-even point moves down, and your profit, you start generating profit sooner, right? Sustainable growth ratio. This is kind of interesting. This kind of looks at whether or not you can sustainably grow your business based on how it's all set up right now. So your dividend payout ratio, retention ratio, return on equity, and then your sustainable growth ratio. Pretty interesting stuff. Current ratio, current assets divided by current liabilities. So this looks at, the industry average is 1.52. If yours is 1.46, okay, how can we free up more capital so we have more current assets and less current liabilities, right? Quick ratio, same thing. Quick assets, current liabilities, days inventory. So this is how fast you turn your inventory. Obviously, if your industry is 30 days and you're turning it in 45, you either have too much inventory or you're not selling. Well, you're obviously not selling stuff fast enough, but why is that, right? Is it because you have too much inventory or what's going on? So that's something to look at. Because if you have too much inventory, reduce that inventory, you might be able to generate a couple $100,000. Now all of a sudden you got a couple $100,000 to throw at these other problems to de-stress yourself, right? De-stress your business. There you go. So accounts receivable days, same thing. Days payable ratio, similar. Return on revenue, so this is how much is going to your bottom line, how much profit, free cash is hitting that bottom line. Return on assets. So, what's your return on the amount of assets you've deployed? Return on equity, similar thing, but it's return on the capital you've deployed. Your money, all right? Current liabilities, net worth. So what's company worth? And then current liabilities, short-term liabilities divided by total shareholders' equity. Long-term liabilities, net worth. So this is long-term liabilities divided by total shareholders' equity. Again, these are financial ratios. Gross profit margin ratio. So this looks at how much gross profit, right, you're generating on each sale. So it looks at, okay, if the industry, normally it's 41% and yours is 22%, well, how do we change that? How do we increase your prices so that you get more gross margin, so you get more to the bottom line, right? Employee performance, so how much revenue and how much income per employee. And then here are the comps, right? So here are the industry averages. Here's your business. Same thing, industry averages, your business. And then we go into the value gap analysis. So based on all this stuff that we talked about, all the stress factors, and then all of the ratios compared to your business, okay, how much money is there for you to make, right? So the profit gap, so you're already, if like this business here is already generating outsized profit as compared to the industry. So there's probably not a huge amount you can do as far as just the profit. But you could de-risk the business. By de-risking the business, now all of a sudden, in this case, there's 50% more value to generate here. So over the course of a year, if you spent a year or 2 years de-risking your business, this person, for example, could make upwards of $1.5 million, right? So you got all these risks and your score, current value, target score, potential value, and then here's your value gap. And then, like I was saying, the capital risk stuff. This allows us to really understand whether or not there's money that's sitting there that you could then redeploy to fix these growth risk and operational risk, operational stressors and growth stressors, right, in your business, right? And all that is going to increase the amount of value to the bottom line. So you do this, you improve your profitability, you reduce your risk, and here's your total, right? Obviously, there is profitability. The way we look at it in our valuations is just as a percentage of revenue. But obviously, there are ways to increase the profitability in pretty much every business, whether that's reducing your fixed costs or increasing your gross margin, one of the two, or increasing the amount of sales, the revenue, right? So I just wanted to talk about that, and that's kind of one of the coolest things I think about our valuations that sets them apart is basically we have this value enhancement program we can put together to help you maximize the proceeds of disposition, right? So your cash at close. So how much money you take home when you sell your business. But even if you're not selling your business, we can help you figure out, okay, where are the most efficient places to invest in your business, and where is that money going to come from to reinvest in your business? So it doesn't even take external capital a lot of times. A lot of times there's inefficiencies within the business, and unlocking or fixing those inefficiencies or pointing them out so you can fix them, right, is going to provide the capital required to fix the other stressors to improve your quality of life. And both those things are going to actually increase your net worth substantially, right? So probably my favorite part of the whole valuation, the whole MVA premium. This would be kind of a valuation that you might want to do every year, because each year is going to help you track, okay, how much money did you actually make in equity, right? Not just how much cash, how much profit, but also how much equity. Like what's your business now worth, and did your reinvestments make sense in the business, right? So if your business generated $500,000 worth of EBITDA or $1 million worth of EBITDA, and you reinvested $800,000 in your business, well, did you reinvesting $800,000 in your business, did it generate $800,000 worth of equity for you? Did it generate $200,000 worth of equity for you? Or did it generate $2 million worth of equity for you? Right? Anyways, God bless Ralph, the Zatara Transaction Advisors here out of Saskatoon. And I hope you have a wonderful day. Ciao.